Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar on contract adjustments, we'll answer some of the questions you may have about how corporate actions can affect your options investments. As always, we'll cover the material as well as your questions in a quick 60-minute session. Our instructor today is a senior specialist with the Investor Services team at OIC, Mr. Bill Ryan. If you've ever called the Investor Services line at 888-OPTIONS or chatted with us online, you might have spoken with Bill. He brings more than 25 years of experience to our discussion today. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Bill will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. We've added some new questions to the survey and would love to hear your thoughts on time of day for our webinars. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And don't forget that the OIC has live events coming this fall to a city near you. Our evening seminar schedule kicks off in Chicago this September and will be followed by similar events in the New York area, Boston, Los Angeles, and the Dallas area. Make sure to check our full schedule at optionseducation.org. And now, ladies and gentlemen, Bill Ryan will bring you our topic today, Understanding and Taming Contract Adjustments. Bill?
Thank you, Nick. It's a pleasure to be here to talk about one of my favorite subjects, contract adjustments. A little technical difficulty here. One moment, please.
Bill, if you're having any trouble with the arrows,
Yeah, I'm sorry. I'm having difficulty with the arrow here. All of a sudden, I lost my momentum.
Not a problem. Tell you what, Bill, why don't you just go ahead and let me know.
There we go.
Like to advance the
Just
clock.
reset.
I'll get it for you. Very good. Sorry about that,
Thank
ladies
you.
and gentlemen. Bill, go ahead.
Thank you for your patience. It should be noted that options involve risk and they are not suitable for everyone. It's important that traders be familiar with the characteristics and risks of standardized options. In fact, some of the examples provided in this webinar come right from this important document. The Options Industry Council is funded by these 12 U.S. option exchanges and OCC. This slide just gives you a good idea of the tremendous volume that occurs in options contracts. Note these are in billions of contracts on an annual basis. Just over 4.5 billion contracts per year. Our topic is contract adjustments for various corporate actions. We're going to talk about 8 of these types of contract adjustments. A few note about contract adjustments. A few notes. Companies whose common stock underlie equity options contracts commonly decide to split their shares, make special stock or cash distributions, merge with or acquire other companies, and or reorganize their corporate structure. Decisions to implement these events, collectively called corporate actions, are made by the underlying companies and often result in fundamental changes in the value of the issued shares. All adjustments to contracts are made by the adjustment panel of the OCC Securities Committee. The adjustment panel is comprised of representatives from OCC and each exchange which trades the affected option. Corporate events are considered on a case-by-case basis. This class will cover adjustments that are typically made to equity options when the underlying stock undergoes a split, pays a special cash and or stock dividend or stock distribution, or is involved in a merger, acquisition, or corporate reorganization. What you learn here are not hard and fast rules that will apply to each corporate event. In real life, the details of each event can vary and require slightly different adjustments to account for them. These are hypothetical examples, and it is important for the trader to be fully informed about the details of such events that may impact your positions. We do make a couple of assumptions in this class, and I might have to repeat these later in the webinar. These contracts are for regular 100-share American-style equity options. These contracts have not been previously adjusted, and the adjustments are being made based on public information. A few reminders here. The deliverable, when we talk about the deliverable on an options contract, we're talking about the unit of trade. This is what changes hand when the call or put is exercised. A traditional options contract represents 100 shares of stock. The deliverable may be adjusted to include newly distributed assets. And then just a quick review of option symbology. Classic company XYZ. Then the number 17 represents the year in which the contract expires. That's 2017. 15 is the day of the month in which the contract expires. And then, of course, December 50 call. So we're looking at an XYZ December 2017 $50 call. When adjustments are made to options contracts because of mergers or acquisitions, the following terms may be modified. The deliverable, the option symbol, the expiration date might be accelerated. Exactly which terms are affected is dictated by the event that necessitates the adjustment. We have an example here of company XYZ merging into NewCo. NewCo is going to pay $85 cash per share to XYZ shareholders. Again, that's one share of XYZ is the right to receive $85 in cash. So for our 100-share contract, that represents $8,500. Before the merger is consummated, when a call or put is exercised, 100 shares of XYZ stock changes hands. After the merger is consummated, after NewCo buys XYZ, trading on the stock and options will halt concurrently. Call or put exercisers receive cash instead of stock. Settlement is accomplished through OCC's cash settlement system. And here's a little chart with a chart table with the information about our XYZ options company. If you owned one XYZ $50 call, you would still own one contract. Your number of contracts would not change. The deliverable, instead of being 100 shares of stock, is $8,500. The strike price is unchanged. The contract multiplier, typically 100, remains unchanged. The option symbol does change, and it becomes NEWC1. And we have a representation of the option symbology change below there. XYZ 1715 D's 50 call becomes NEWC1 1750 D's 50 call. Now these contracts settle to the difference between the extended strike price and the cash deliverable. The cash deliverable again was $8,500. Our strike price was $50 times the $100 multiplier, $5,000. So $8,500 minus $5,000 means our options contract, our $50 call, will settle to $3,500. In an all-cash merger, the expiration date is likely to be accelerated. So even though this was a December 2017 contract, it will almost certainly have its expiration date accelerated or moved up. When the contract is adjusted to call for a fixed amount of cash, out-of-the-money options will be worthless, and any in-the-money options will have no time value, no extrinsic value, all intrinsic. Another merger example is provided here. Company XYZ is merging into Newco Company. Newco Company will pay for each XYZ share. They'll give you a half a share of NEWC stock and $3.50 in cash. So we see our 100 shares of XYZ become 50 NEWC shares plus $350. That $350 amount does not fluctuate with the price of the acquiring company stock. That is a fixed dollar amount. Of course, our option symbol is going to change as well. What used to be an XYZ call is going to be an NEWC1 call. After the merger adjustment, the NEWC1 options will trade until they expire. A bit more information providing the details of our contract adjustment. Again, the number of contracts remains the same. It's unchanged. The deliverable, of course, changes. It's now 50 shares of the acquiring company stock and $350 fixed in cash. Strike price remains unchanged. The multiplier remains unchanged. And again, the option symbol becomes NEWC1. Before the merger, it was an XYZ D's 50 call. After the merger, it's an NEWC1 D's 50 call. It's important to note the NEWC1, that numeric suffix at the end of the stock ticker. That is an indicator. That's a guidepost for the option trader. That tells us that there is something interesting or non-standard or not normal about this contract. This is an example of NEWC1 options contracts at expiration. We stipulate that NEWC is trading at $99 a share. The NEWC1 $50 call option is in the money. It's in the money if 50 shares of NEWC and $350 are worth more than the value of our strike price, which is 50 times 100 or $5,000. So our example, 50 shares of the stock at $99 a share is $4,950. Then again, we have our fixed $350 cash component. We add those two pieces together, it's $5,300. So our NEWC1 $50 call has $300 of intrinsic value. Estimated price of the option at or near expiration date with the stock at $99 it should be about $3. It wouldn't surprise me if it was bid $2.95 and offered $3.05, but its intrinsic value is $3. Our next segment discusses special or extraordinary cash dividends. There's two adjustment methods for this type of distribution. A reminder, contract adjustments in general can be made for special cash distributions. The following terms can be modified: the deliverable, the strike prices, and the option symbol. Which terms are affected depends on the event that necessitates the adjustment. And depending on the nature of the adjustment, a new class of options may be listed with standard 100-share terms. In our first example, company XYZ announces a special extraordinary cash dividend of $3.75 per share to its stockholders. So for the XYZ options contract adjustment, of course, your number of contracts remains unchanged. The deliverable remains unchanged. It's 100 shares of stock. But here's where the adjustment kicks in. The strike price is reduced by the dividend amount. The multiplier remains unchanged. The option symbol remains unchanged. Before the special cash dividend, in our example, we had a December $50 call. After the dividend, we have a December 46.25 call. You'll notice that the option root symbol XYZ does not have the numeric suffix at the end of the stock ticker because this is a standard 100-share contract. It's just got a funny looking strike price. So in this example, the aggregate exercise amount before the dividend, that's a $50 strike times 100 or $5,000. The aggregate exercise amount after the dividend is 46.25 times 100 or $4,625. The premium is the quoted price times the $100 multiplier. So an option price of $250 translates to $250 in premium. Some folks will call me up and say, Bill, should I exercise my call so I can actually receive the dividend? I guess we'll say that's a personal decision. But the fact that the strike price is being reduced doesn't obligate you to exercise that contract. Exercise the call option, pardon me. Our next example is a special cash dividend. Again, it's the same $3.75 by XYZ. The number of contracts remain unchanged. The deliverable in this case, or in this situation, does change. Aside from the 100 shares of stock, the $375 dividend, 3.75 times 100, is going to be attached to the deliverable. That's a fixed cash amount. Because the cash is being attached to the deliverable, the strike price is not changed. The multiplier does not change. But because we have changed the deliverable from 100 shares to 100 shares and the $375, our option symbol is adjusted and it becomes XYZ1. Again, before the dividend, XYZ, December 50 call. After the dividend, it's an XYZ1, December 50 call. Now, the interesting scenario here about XYZ and XYZ1 at expiration. Remember, I mentioned to you that depending on the nature of the adjustment, a new class of options might be listed with regular 100-share terms after the contract adjustment. If a new 100-share contract was issued after the adjustment, and at expiration, XYZ closes at $47.50 a share, there's going to be two different options contracts trading on XYZ with a December 50 strike price. One of them's XYZ D50. That's a plain 100-share contract. It's out of the money by $2.50. The XYZ1, again, notice the numeric suffix there. That call option, that contract has stock and cash attached. This December 50 call, this XYZ1 D50 call, is in the money and it has intrinsic value. Again, our stock's at $47.50, $3.75 in a fixed cash deliverable. This December XYZ $50 call is in the money by $1.25. Next, we're going to talk about equity distributions, stock dividends, and spinoffs. Familiar slide at this point. Contract adjustments in general. When adjustments are made for equity distributions, the following terms can be modified: the deliverable, the strike price, the option symbol, and the multiplier. Again, depending on the terms of the distribution, that will dictate the nature of the contract adjustment. And depending on the adjustment, a new class of options contracts with a standard 100-share deliverable may be listed. Our first example, company XYZ announces a 4% stock dividend. And this is what we would expect to see as far as the contract adjustment in this example. The number of shares changes from 100 to 104. Of course, the number of contracts remains unchanged. The deliverable changes from 100 to 104. The strike price gets divided by 1.04, and we round the strike price to the nearest penny. The multiplier changes to 104. We've got a 104-share deliverable, $104 multiplier. And as you would expect, since this is a non-standard contract, the option contract symbol changes to XYZ1. Before the dividend, before the 4% stock dividend, we owned an XYZ December 50 call. After the 4% stock dividend, we own an XYZ1 December 48.08 call. In this example, we're talking about a spinoff. In the notes here, XYZ spins off its subsidiary TUV to its shareholders. The terms of the spinoff is for every share of XYZ you own, you will get a quarter of a share of TUV. So, for the XYZ spinoff of TUV to shareholders and for the options contracts, this is what we should expect to see happen, or this is a typical spinoff adjustment. The number of contracts remain unchanged. The deliverable changes from 100 shares of XYZ to 100 shares of XYZ and the spinoff shares, 25 shares of TUV. The strike price remains unchanged. The multiplier remains unchanged. And since we have changed the deliverable, we should expect the option symbol to be adjusted to something along the lines of XYZ1. Again, before the spinoff, we were long an XYZ D50 call. After the spinoff, we are long one XYZ D50 call, XYZ1 D50 call. Now at expiration, remember, we're making the assumption that a standard 100-share contract is issued after the spinoff. So if a new standard 100-share contract was issued and XYZ closes at 48 and a half per share, and TUV closes at $16 a share, the standard 100-share contract with a strike of 50 is out of the money and has zero intrinsic value. Compare that to the XYZ1 December 50 call. This call is in the money and it has intrinsic value. The math is there at the bottom of the slide. The value of the two components in this deliverable is $5,250 based on XYZ being at 48.5 and TUV being at 16. This contract, this $50 call, has intrinsic value of $250. Next up are stock splits. Another familiar slide. Contract adjustments. When adjustments are made to account for a forward or reverse split, the following terms can be modified: the deliverable, the strike prices, the option symbol, and the multiplier. Exactly which terms of the contract are adjusted is dictated by the event that necessitates the adjustment. And again, depending on the nature of the adjustment, a new class of options might be listed with regular standardized terms. Just a quick reminder, in this webinar we are discussing options that have not been previously adjusted. These are some common questions or considerations that are presented to myself and my colleagues at the OIC Investor Services line. So someone will call and say, "Bill, do I have to exercise my contract to participate in this stock split?" And the answer is it's not necessary to do so. For a covered call writer who buys stock and sells a covered call, and the stock announces a 2-for-1 stock split, generally speaking, no action is necessary on your part. The stock and the options contracts will be adjusted, and you will maintain the correct balance and correlation of shares owned to options contracts written and the number of shares controlled in those options contracts. The effective date for contract adjustments for splits is on the X date for the underlying stock. In our stock splits section, we're going to discuss even splits, where one whole share is issued for each share currently held. Classic example is the 2-for-1 split. There are 3-for-1 splits, 4-for-1 splits. In the not too distant past, we have seen 7-for-1 stock splits. Then we have an odd split. This is when a whole share plus a fractional share is issued for each share held. An example for this is a 3-for-2 split, or a 4-for-3 split and a 5-for-4 split. These first two splits that are discussed, the even split and the odd split, these are forward splits where more shares are being introduced. The last example is the reverse split. In a reverse split, a fractional share is issued and exchanged for each whole share held. An example would be a 1-for-2 reverse split, a 1-for-5 reverse split, or 1-for-2.5 reverse split. First example we're going to discuss is the 2-for-1 stock split. In a 2-for-1 split, the number of contracts would be doubled. They would be multiplied by 2. The deliverable would be unchanged. The strike prices, as you would expect, would be cut in half, divided by 2. The multiplier, since we're dealing again with a standard 100-share contract before and now 2 standard 100-share contracts after the split will remain 100, and the option symbol, again, since we are only talking about a 100-share contract, the option symbol doesn't have to be changed, and it won't be changed. In our 2-for-1 split, company XYZ, we have a December $50 call in our example. Before the split, we owned one $50 call. After the split, we own 2 contracts. 2-for-1 makes sense. The deliverable before the split, 100 shares. The deliverable after the 2-for-1 split remains 100 shares. The second change we're going to see here is in our strike price. What we originally had was one $50 call. Now we own 2 $25 calls. The multiplier remains 100. The option root symbol, XYZ, remains unchanged. Again, before the split, we owned one XYZ Dece 50 call. After the split, we own 2 XYZ December 25 calls. Our next example is an example of an odd split, an odd forward split, 3-for-2 stock split. The number of contracts remains the same. The deliverable gets multiplied by 1.5, and the strike price is divided by 1.5. Also, the multiplier changes from 100 to 150, and since we have a non-standard something other than 100 share deliverable, we would expect the option symbol will change as well. So before the 3-for-2 split, we owned a 1 December 50 call. Before the split, we own 1 call. After the 3-for-2 split, we own 1 call. Before the split, it was a 100 share deliverable. After the split, it's a 150 share deliverable. Strike price before 50, afterward 33.33. The multiplier was 100. It now becomes 150. The options contract symbol used to be XYZ. It is now XYZ1. And this is what you might expect to see in an option chain before and after. Let's talk about the 3-for-2 split, the aggregate exercise amount before the split. If you were to exercise a $50 strike, a $50 call, you would pay 100 times the strike of 50 or $5,000. After the 3-for-2 split, if you were to exercise your new strike of 33.33 times the new $150 multiplier, the money coming out, or the cash that's changing hands, is $4,999.50. We do round to the nearest penny. Another important note, the premium, or the quoted price of your options contract, the multiplier is now 150. So, if you see an options in a 3-for-2 split adjusted contract, if you see the premium quoted at 2.5, you've got to do the math. It's 2.5 times 150. The total premium that would change hands in that example is $375. And now the reverse split. With reverse splits, the adjustments are made to the deliverable. The number of shares are decreased by the amount of the reverse split ratio. As you would expect, since we are changing the deliverable to something other than 100 shares, the option symbol will be adjusted. Particular note, adjustments are not made to the number of outstanding contracts in your account. Adjustments are not made to the strike prices in your account. Adjustments are not made to the multiplier. It remains 100. And a new class of options can be listed after the reverse split with standard terms, with 100 shares deliverable. This is important. A further note, in some cases, in a reverse split where they reduce the number of shares outstanding, the security in question might not be eligible for continued options listing because they don't have enough shares outstanding. So here's our 1-for-5 reverse split example. As again, the number of contracts remain the same. The deliverable gets divided by 5. Strike prices and multipliers remain the same. The option symbol, because we are changing the deliverable, we would expect that that option symbol is going to be adjusted. So before the 1-for-5 reverse split, we were long a December $50 call. We're going to compare before and after the reverse split. It's a December $5 call. I may have misspoke there. The number of contracts remains 1. Before and after the split, we owned one $5 call. That options contract delivered 100 shares before the reverse. It now delivers just 20 shares. The strike price was 5, remains 5. The multiplier was 100, it remains 100. And again, the option symbol, we would expect that option symbol to change from XYZ to XYZ1. So, before the split, we owned an XYZ Dece 50 call. After the split, we own an XYZ1 December 50 call. And I just, as for a pricing example, before the split, I said XYZ stock was trading at $1. And after the reverse split, we would expect that to be 5 times higher. So if it closed before the split at $1, on the effective date of the reverse split, if it opened at $5, it would be considered unchanged in price. So, in our reverse split example, we are stipulating that at expiration, company XYZ is now trading at $7 per share. Assuming that a standard 100-share contract was issued following the reverse split, we're going to have 2 different options contracts trading side by side. The adjusted XYZ1 $5 call and the standard XYZ $5 call. So, with the stock at $7 a share, our adjusted contract, the value of the contract is $140. We've got 20 shares of stock at $7 per share. I can do that math. It's $140 worth of stock. Our strike price, on the other hand, it's $5. Our $5 strike times 100, $500. If we were to exercise this call, we would pay 100 times the strike of 5 or $500, and we would take delivery of, well, we'd only take delivery of 20 shares. So that would not be a sound exercise decision. As illustrated here, the intrinsic value with company XYZ at $7 a share, the intrinsic value is 0. On expiration Friday, with the stock at 7, XYZ1 $5 calls, shouldn't surprise you to see that 0 bid. Compare that or contrast that to the standard 100-share $5 call. 100 shares of stock at $7 a share is worth $700. Our strike price of 5 times 100 is worth $500. This standard $5 call, it has intrinsic value. It has in-the-money value of about $200. We would expect that that options contract would be worth about $2. I know that was a lot of information, and we have plenty of additional resources to help you learn about this important topic. Of course, you can visit the OCC website and pay particular attention to the bylaws, Article 6, Sections 11 and 11A, the characteristics and risks of standardized options, this is my Bible. It has examples of several of these types of adjustments we've just discussed. Of course, the exchanges, the individual exchanges that trade the affected contracts normally issue information bulletins in that respect. The Options Clearing Corporation, OCC, issues information memos. In fact, if you're so inclined, you can visit the OCC website and subscribe to receive to their subscription center and ask to receive contract adjustment alerts delivered right to your desktop. We make it really easy for you to be fully informed. Of course, the Options Industry Council has a terrific class on contract adjustments. It's free of charge. The only requirement is you take the time to register with OIC Education. Of course, you can always contact your brokerage firm, or you can call the Options Industry Council Investor Services. That's me. You can call us at 888-OPTIONS. That's 888-678-4667. Thank you, Nick.
Bill, thanks for your expertise. And while we do have some questions today, I do want to remind our listeners that if you have further questions about the concepts we discussed or the tools on the OIC website, or if we're not able to get to the question you submitted, feel free to give Bill, or another member of the Investor Services team a quick call at 888-OPTIONS. As he mentioned, they're always ready to help answer questions about option strategies or positions. Additionally, today's session will be archived, as I mentioned, and accessible in a few hours using the same link you used to join us today. Additionally, our webinars are available on the OIC YouTube channel, so you can review a number of options, strategies, and concepts at your own pace. And Bill, our first question came fairly early on, and it was about reverse splits. With regard to reverse splits, why doesn't the strike price change?
Well, that's a great question, and it's a common one. And the fact of the matter is, if we did, or if the strike price was changed, we would also, of course, we're changing the deliverable. If we change the strike price, we also have to change the quantity of options contracts. In a reverse split, in our example, a 1-for-5 reverse split, if you owned 2 options contracts before the reverse split, and we did, in fact, boost your strike price, you would end up with less than a whole options contract, because we would have to reduce by a fifth, we would have to reduce the number of options contracts you had. So this is a very subtle adjustment that effectively changes your strike price. Before the split, we had a $5 call, and it represented 100 shares of stock. After the split, we have a $5 call representing representing 20 shares of stock. The math involved there, for a $5 call to be in the money when it only controls 20 shares of stock, the stock would have to be at it would have to be at $20 a share. Agreed? So the math works out, and your strike price is effectively changed. That's sort of a mental note that you would make. Where does the stock have to be for my contract to be in the money? In this example, it would have to be above $20 a share.
Bill, in a
check that, $25 a share. My bad. I'm sorry, Nick.
Sorry.
Go ahead.
No. If you'd like to continue with that question, that's fine. Okay, we can move on then. And in a special cash dividend scenario, what determines if the deliverable changes or not?
Again, a wonderful question. The preferred contract adjustment is to simply reduce the strike price by the amount of the special or extraordinary cash dividend. In some cases, the cash distribution amount is a significant dollar amount. One that springs to mind, a few years ago, a company paid a $9 special dividend. And in fact, they happened to have $5 calls available. If we were to reduce the $5 strike by $9, we'd be looking at a negative strike price. That's not going to happen. In that type of case, where the strike price would be reduced to below zero, it's typical to see the deliverable change to include a prorated amount of cash. And Nick, back to that reverse split question, the effective strike on the $5 call is 25, not 20. I actually had to use my calculator. I apologize. I'm sorry, back to you.
That's the best way to do it. Duly noted, Bill. Bill, you mentioned the importance of distinguishing between a standard and an adjusted contract. We had a few listeners ask and want you to remind them of why that's important.
Well, I believe it's important because an expiration Friday, when there's the standard contract trading alongside the adjusted contract, it's important, or it's a good question for the trader to ask themselves why. Why is this contract more valuable than that one? There must be something about this that I don't know or I need to find out. The markets are fair, and they will price an options contract accordingly. Don't think that you know more than the financial markets. Chances are you need to get more information so that you can make an informed trading decision.
Bill, one of the listeners wanted to know a little bit about the symbology changes. So the adjusted option symbol changes, such as to XYZ1, only if you already have that option, and then you'll see that in your account as XYZ1. But what is the option symbol if you are buying the option after that adjustment is made?
Well, this actually, Nick, this goes back to the previous question to a certain extent. After the adjustment is already made, and a standard 100-share contract has been introduced, it's not uncommon to see an XYZ DC50 call trading alongside an XYZ1 DC50 call. Just because an options contract has been adjusted to change the deliverable, for example, doesn't mean they're going to stop trading or stop quoting that contract. So it's important to know why is there an XYZ DC50 as compared to an XYZ1 DC50, and the trader can visit the OCC website and search for contract adjustment memo on XYZ1 and better inform themselves so they can make an intelligent trading decision. It's really all about saving money, Nick.
That's what it's all about, that bottom line, Bill. Our last question today, if there is a reverse split and due to too few shares outstanding in the options listing being discontinued, what happens to that outstanding option that was previously bought and sold?
Well, if the security following the reverse split it is no longer eligible for continued options listing, a couple of things we would expect to see happen. One, they won't issue any new standard 100-share contracts. They will, I would expect. Now, this is a hypothetical, so I'm not winging it, but I'm guessing here. I would expect that the exchanges would allow for closing transactions for everybody who's got a position in this contract. You'll be able to close it out based on the price of the security, but that you will not be allowed or able to enter into any opening transactions. You can't open up anything. You won't be able to roll your position from 1 month to another. You won't be able to buy any more contracts if, or again, open any long or short positions. You can only close.
Bill, do you have any closing comments or thoughts for our listeners today?
Yes, I would encourage you to visit optionseducation.org and take a look at our contract adjustment class. There are numerous examples provided there, probably about another half dozen or so than what we've just discussed. And to pay particular attention to your option symbology, and don't expect, I would expect that you would prefer to call and find out what the contract is before you trade it versus calling your broker or calling me or Options Industry Services and say, what have I done? So inform yourself, and that will allow you to make an intelligent trading decision.
Bill, thanks for your time and expertise today. And ladies and gentlemen, thanks to you for attending. We hope you enjoyed it and learned something today. You can always give Bill and our investor services team a call at 1-888-OPTIONS during most business hours to answer your questions about options or positions. Feel free to reach out to them. And you can always visit optionseducation.org, as Bill mentioned, the OIC's website, and you can start with the Getting Started section for further reading. That should get you a wealth of options materials to start with. Again, today's session will be archived and accessible in a few hours using the same link you've used to join us today. Our webinars are available on the OIC YouTube channel, so you can review a number of option strategies and concepts at your own pace. And of course, make sure to check optionseducation.org in the upcoming weeks for our 2015 sessions that are coming up. And if you're in the New York, Chicago, Boston, Dallas, or Los Angeles areas, please come to one of OIC's evening seminars this fall. The full schedule is available on the website, and our season kicks off September 16th in Chicago. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.